morning, everyone. So today we have Idika in the studio, and there was an MPC meeting, yesterday, right? Was it yesterday?
Yes, yesterday.
Yeah, exactly. Yeah. So,
Yesterday.
we're looking to how that meeting will actually, impact investment asset classes, and we want Idika to, help us define that, so our investors and our listeners will know how to apply themselves, with the outcome of the meeting. So, Idika, before we, let's just go straight into it. Funny enough, right? So, we're dealing with figures here. So, let's start with the big news, right? Which is the Central Bank of Nigeria, has retained the MPR at 27.5%, the cash reserve ratio at 50%, and the liquidity ratio at 30%. So what does this mean for investors and the wider economy?
Yeah. First of all, good morning.
Good morning.
Good morning, Kayode.
Good morning.
And viewers and listeners. I'm happy to be back again. Yes, the MPC meeting was held yesterday, and like you rightly said, the MPR was retained at that rate.
Yeah, 27.5.
27.5.
Yeah.
Then the
CRR
rate at 50%.
50%. Yeah.
The liquidity ratio
at
at 30%.
Mhm.
Yes, analysts and the market expected that they will return it to at least to continue to gain from the slowdown in inflation. Inflation came down from I think from 24.23 in March to 23.71.
Okay.
23.71 in April.
Okay.
So relatively a slowdown. So I think they want to maintain that slowdown. This is the MPR rate is one of the monetary policies that CBN uses to control inflation. So I think that's the reason. And for the economy, one, it means basically for investors, even for borrowers, that lending will still be expensive. So people are still going to, if you want to borrow your mortgage loan, your retail loan, and even commercial loans are still going to be expensive because they're still retaining the MPR. MPR rates just means the rate the CBN gives money to the commercial banks. So at that rate, retaining at that means that all the existing loans will still be expensive.
Okay. It just reminded me, said if inflation slowed down a bit. It doesn't feel that way, but the figures say otherwise. So let's go into asset classes. So how does the CBN's decision, affect investors? The different types of investments, rather.
Okay, normally you have the fixed income investors, that's a fixed income asset class. You have then the commodities, then you have equities and other asset classes. Now, at retaining the MPR rate at 27.5, definitely it's not as if that the fixed income market is still going to come down, because even at that, most of the fixed income assets are still giving returns below the inflation rate.
Okay.
For treasury bills, bonds, they are still giving the yields still having a yield of between 18 to 20%.
Okay.
And for federal government bonds, still that one gives you a little bit higher yield between 19 to 21%.
Okay.
So in essence, it means that we are still losing money because the real rate of return is still negative. But when you compare the real return with the MPR and inflation, at least you're having a slight positive real return of about 3.79, because the inflation rate is at 23.71, while the MPR rate is 27.5. So you see, you have a positive return. So, but for other asset classes like fixed income, fixed income and others, you still have their nominal rate is still lower than the inflation rate. So that still gives you negative return.
Okay.
Which is that means you are still losing your purchasing power.
So
that's the implication.
Yes. So I mean, and dividend paying stocks, right? So why I want to speak to that really. So why are they important right now really, and how are they related to the high MPR we're talking about?
Okay. Yes. Stocks are another asset class that you can invest. I've mentioned the fixed income asset, basically the treasury bills, bonds. Now, why it is important, because like I said, we've talked about it severally here, that it is important that you ensure that your return is higher than the inflation rate. Otherwise, you'll be losing money. Now, if you look at equities, that means the stocks. Now, stocks are somehow another asset class that can give you return more than the inflation rate. Now, because of the MPR now, so you have to focus more on maybe look at stocks that pay dividends. If you look at the stock that pay dividend, because that dividend yield will now add to what we call your total shareholders return. That will now be able to help you to move above the inflation rate and have positive real return. That is where the angle of dividends comes in. That is where dividend comes in. Not only the capital appreciation, that is the increase in share price. Now, if you pick stocks that pay dividends, the dividend yields, that's the cash you receive from investing in that stock, buying that stock, plus the share price appreciation will help you have a return that is likely to beat that inflation rate. So that is why it is important that this rate, with CBN retaining the MPR rate at this rate, which is still high, you have to be a little bit conscious, intentional on the choice of your, even if you want to invest in stock, your choice, especially go for stocks that pay dividends. So in that case, with that dividends and share price appreciation, you'll be able to beat that inflation and have a really positive return. Okay. For instance, now, actually, if you invested in Dangote pays a dividend. I think they declared 30 naira dividends per share. Then you have that one.
Okay.
Then actually, if you offer a dividend yield of let's say 5%, then the shares appreciated. You have about maybe say within that period you are measuring, you have the appreciated by maybe say 30%. 30 plus 5. That will give you 35%.
35%, sorry. I almost said 40.
Yes, 35%. Unlike when you bought stocks that do not pay dividends. So you only rely on the share price gain.
Right.
That's what we call the capital gain.
Okay.
So you see how dividend stocks play a very vital role.
And so if dividend stocks are attractive now, right? How can an investor, tell whether a company's dividend, stock is actually safe or unsustainable?
Okay, that's a very good question. Normally, you measure just like you look at the capital gain, that is share. When you bought at 10 naira last year, and the stock has appreciated to maybe it's going for 20 naira. You can see you have a capital gain of 10 naira, right? Now, normally we measure in terms of dividend. You measure in terms of dividend yield. That shows you the actual cash you are getting in relation relative to the share price of the stock. Okay. That is the dividend yield. But you have to be, when you want to decide which stock to buy, you have to be very, very careful with that dividend yield. Because dividend yields, if the share price, the dividend yield can be high because the share price has dropped.
Yes.
Do you get the point?
Yeah.
So you don't have to depend solely or concentrate solely on the dividend yield. So the other things that can now help you to decide, okay, which particular stock, dividend stock to buy. One, you have to look at the payout ratio.
Yes.
The payout ratio in relation to what I mean by payout ratio, how much profit after tax the company is making, and how much is paying out in dividends.
Yes.
That will now give you the payout ratio, which is very, very key.
Okay. I think the audience should take note of that.
Yes, you look at the payout ratio. Then you now look at what we call dividend growth rate. Normally measured in what we call compound annual growth rate. Has dividend been consistent? Let's say for 5 years. What is the growth rate? When you look at it, you now calculate, find out if maybe a company B, the growth rate is 10%. That means has been paying, has been increasing the dividend payout for by 10% every year for the past 5 years.
Okay.
So those ones that have been consistent increasing their dividends, that's a good omen. That's a good thing. It's a sign that yes, there's sustainability in paying their dividend. Then you equally look at the earnings of the company. Because normally you pay dividend from the earnings of the company and returns earnings. So if somebody's company is making losses, definitely the company cannot pay dividends.
He can't.
So you concentrate on look at the earnings of the company. Is the company profitable? So these are the things that can now guide you to say, okay, fine, I want to pick this stock. Then equally to why dividend is very important. That's what we call total shareholders return.
Yeah. Which
is very, very key. That will actually gives you the idea of how much you are making from investment in stocks. Because now the stocks appreciate in share price. They can equally decline. The same thing with dividends. You know, when you have your dividend one side, now the total shareholders return shows you what you are making from a particular stock, both in share price appreciation and in dividends.
Dividends also.
Now you have cash dividends, you have what we call stock dividends. You have what we call bonus issue. At times companies will now issue bonus issue to their shareholders. Now if you open it, that means your outstanding shares, I mean like you have 1,000 shares in Zenith Bank. And Zenith Bank issued bonus issue. Maybe 1 to 3. You have one, they give you additional 3. You know, that will now increase your outstanding shares with Zenith Bank.
Yes, definitely.
Now, at the end of the period, when you add all of them, you have to bring it in. Not only the share price increase. You have to bring the additional shares given to you. Then the dividends you have earned. When you add all of them, get your position at the beginning of the period you are measuring, add the dividend paid to you, then divide it by the shares outstanding you had at the beginning. At the end of the period you are measuring, add the dividends paid to you in absolute terms, then divide it by the one that's you started with. That will not give you a total shareholders return. That will not give you an outlook. So, okay, fine. So far, I have made the return on these investments is about maybe say 50% or 100%.
Okay.
So that will not give you. It's only that when you have it like that, so you cannot know whether your investment has actually outpaced the inflation rate and is giving you real return. So that is where dividend comes in.
I really love a recap of this, but anyway, I'm pretty sure the viewers can watch.
That's where dividend really comes in. And another thing is that you can equally, even if you don't want to buy into or you don't want to invest in dividend-paying stock, you can equally use what we call dividend capture strategy.
Dividend capture strategy.
Yeah, dividend capture strategy just means that, okay, Dangote Cement has declared dividends. And this dividend is going to be paid, for instance, on 20th of June 2025. They normally give you, okay, this is the time we're going to pay this dividend. This is the time we're going to close our register.
Yes.
That means if you have our shares on or before, maybe say on or before 5th of June, you will be able to have this dividend. So you can decide to move funds.
Oh, really?
Yes.
Okay.
You can decide to move funds, buy that Dangote stock, buy like maybe 2,000 units, as the case may be, then wait. Immediately they pay dividends. You can now sell.
Sell. Okay.
Capture the dividend. That's why we call it dividend capture strategy. Capture the dividend. And move. But you have to be very, very careful when using that strategy, because you have to buy stocks that have enough liquidity so that you can be able to exit.
Oh, okay. So last question. I mean, you've mentioned dividend yield so much, but isn't dividend yield already part of the total share, the total shareholders return? And really, how are they different?
Okay. Yes, which I've just explained, but let me just do a recap again. It is part of total shareholders return.
Okay.
But dividend is just like, let me just use this. Dividend is just like you have a house. Dividend is the rent you collect.
Okay.
From the house. Now, total shareholders return is the value of the house plus the rent.
Okay. Makes more sense now.
Do you get it now?
Yeah.
Dividends is just like the rent you collect from owning a house, a real estate. Now, the total shareholders return is like the value of the house inclusive of the rent,
which is the dividend.
Which is the dividend. So you can now see it. So it is that dividend that will now give you the total value of your investment in a particular stock. And which is, some people will just look at, okay, the share price has moved from 1 naira to 2 naira. You can calculate this, okay, the share price has given me, that's a mistake most investors do make. You look at that and it's okay, share price has moved from 1 naira to 2 naira. Okay, just giving me maybe 10% as the case may be. Now, some of them, you don't even factor the dividends. So when you factor the dividend, that will give you total shareholders return, which is very, very key.
Of course.
Even inclusive of any shares bonus issues that we are issued.
Okay, thank you very much, Mr. Idika. I still have so much questions, but definitely we're out of time. But I'm pretty sure I'll get to speak to you more about this, and hopefully the audience can be, brought up to speed about this. So this is Everyday Money Matters, and the show has ended today. You can always catch up with us on our YouTube page. It's at Nairametrics TV. And also, if you just feel like listening to it while you're working out or something, you can also listen to us on Spotify. And we look forward to seeing you next week. Take care. Bye.